Hello and welcome to our video on mastering the moving average indicator. Today, we'll go over 3 excellent ways for using the moving average indicator to generate reliable trade signals. Stay tuned to learn how to use this tool effectively. What is a moving average? A moving average is a fundamental technical indicator that decides the asset's average closing price over a specific period of time. For example, a 10-period moving average determines the average closing price of the previous 10 candles. This technology reduces market noise and delivers a more accurate view of a trend. Different moving averages serve different functions. A 200-period moving average is commonly used to identify long-term market patterns, but a 20-period moving average is useful for determining short-term market trends. Moving averages with periods of 20, 50, 100 and 200 are among the most popular. In general, moving averages are employed to identify market patterns and simplify price movements. But let's take a closer look at how the moving average might help us make better trading judgments. Uses of moving average. The moving average is usually used for 3 purposes: identify the trend, identify a trend change, and identifying areas of support and resistance. Let's start by finding the trend with the moving average. The moving average is a trend indicator. Therefore, its principal job is to help us detect the price trend. We now have 3 approaches to accomplish this. 1. Price versus moving average. The price's position relative to the moving average might assist us determine market trends. If the price is now above the moving average and has continuously remained above it, it is said to be in an uptrend. As sensible traders, we prefer to trade in the direction of the trend. In this case, we should be on the lookout for buy opportunities. On the other hand, if the price is below the moving average and has remained there for some time, it might be thought to be in a downtrend. In this circumstance, we should hunt for sellable chances. Lastly, in sideways or range-bound markets, the price frequently oscillates above and below the moving average rather than sticking in one direction for long periods. This behavior is like a pendulum swinging back and forth. During these situations, it is best to avoid trading and instead wait for a definite trend to emerge. Using 2 moving averages with different period settings can help you conduct a more effective analysis. This strategy helps you to grasp the market's long-term and short-term tendencies. Consider a chart that contains 2 moving averages, a yellow line representing the 20-period MA moving average and a blue line representing the 200-period MA. The 20-period MA is a short-term moving average that provides information about the market's short-term trend. On the contrary, the 200-period MA serves as a long-term moving average, providing an overview of the long-term trend. For the time being, let us ignore the 200-period MA and concentrate entirely on the 20-period MA. If we only look at the 20-period moving average, we can see that the price was consistently higher throughout various times. This implies that the market was in an uptrend throughout these periods, highlighting prospective buying opportunities. When the price falls below the 20-period MA, it indicates a downtrend and potential selling opportunities. However, on closer investigation, we see that there were few substantial price fluctuations during the downtrends. If we reintroduce the 200-period MA, we can see that the price remained above it during the period. This shows that a long-term uptrend was in effect. With this new knowledge, it is evident that selling during this time period would have been dangerous because it would have meant trading against the usual long-term trend. Another example, when we zoom in on this portion of the chart, we can see that the price has been fluctuating around the 20-period moving average for quite some time. This indicates a short-term sideways trend. At the same time, the price held continuously above the 200-period moving average, indicating a long-term uptrend. In this situation, One option is to avoid trading due to sideways movement, or to consider placing buy trades towards the lower end of the range. However, we should avoid making sell trades at the top of the range, since this would oppose the long-term trend. Using two moving averages will not always result in better trades, but it will assist you avoid making poor trading selections. If you're enjoying the video so far, please like it and subscribe to our channel TraderYodha for more videos like this. 2. Moving average slope. The slope of the moving average provides vital information about the strength of the trend. During an uptrend, the moving average slopes higher. In a strong rise, its slope approaches a 45-degree angle. With a weak uptrend, the slope is more gradual and less noticeable. Similarly, in downtrends, a strong downtrend is distinguished by a high downward slope that approaches 45-degree angle. In a weak downtrend, the slope is gentler and less severe. This knowledge is critical because strong trends permit more aggressive trading entry, while weak trends require a more cautious approach to trading. 3. Large versus small moving average. Another way for determining market trends is to use two moving averages and analyze their positions. Consider a chart with two moving averages, 50 periods and 200 periods. The 50 period MA is known as the smaller MA, whereas the 200 period MA is the larger one. When the smaller MA is above the larger MA, it suggests that the price is uptrend and we should search for buying chances. When the smaller MA is below the larger MA, we consider the price to be in a downtrend. And as sensible traders, we should hunt for selling opportunities during this time. These were the three methods utilized to determine a trend in the moving average indicator. Let's see how to use the moving average to detect reversals. There are two approaches for identifying a trend reversal. 1. Price crossover. As previously stated, during an uptrend, the price tends to remain above the moving average. During a downtrend, prices remain below the moving averages. Using the same logic, when the price crosses the previously mentioned moving average, it shows that the uptrend has ended and a downtrend started, indicating a bearish price reversal. Similarly, when the price crosses above the moving average from below, it indicates that the downtrend has ended and a new uptrend may begin. However, keep in mind that not all crossovers are reliable indications, and many can be incorrect. Using a moving average crossover might help you avoid misleading signals. A moving average crossover is a popular approach that combines two moving averages with different period values, such as the 50 period MA and the 200 period MA. Previously, we learned that in an uptrend, the smaller MA is higher than the larger MA, and in a downtrend, the smaller MA is lower. Using the same approach, we can see that when the smaller MA crosses below the larger MA, it indicates a move from an uptrend to a downtrend, implying a bearish reversal. When the smaller MA crosses over the larger MA, the trend shifts from down to up, indicating a bullish reversal. While these crossovers give useful signals, it is not recommended to base trades only on them. Instead, use these signals with other information to make better trading selections. Thus, these are two strategies for detecting market reversals. Next, we'll look at one of the most important applications of the moving average: identifying dynamic levels of support and resistance. Moving averages are an effective way to identify dynamic levels of support and resistance. While support and resistance are usually fixed price levels where reversals are predicted, moving averages can also be used as dynamic support and resistance. During an uptrend, the price often remains above the moving average. When the price returns to the moving average, it frequently finds support, signaling a good time to search for buying opportunities. For example, in an uptrend, the moving average might provide support numerous times. In contrast, a downtrend occurs when the price continues below the moving average. When the price approaches the moving average, it frequently meets resistance. Thus, during a decline, the moving average can be used to identify potential selling opportunities. In this situation, the price encounters resistance 5 times. This demonstrates how the moving average can serve as a dynamic level of support and resistance for prices. Today, we looked at how to successfully use the moving average indicator to improve your trading approach. If you found this video useful, please give it a thumbs up and subscribe to our channel, TraderYodha, to make sure you don't miss any future content. Thank you for watching.